Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Thanks for listening. Continued momentum across the AI trade following a busy morning of earnings beats and other big investment announcements, including Corning and NVIDIA working together. AMD showing us that CPUs are going to be very much so needed in the near-term future of the AI server build-out. Uber showing up strong today, up $6 to $79 a share, up 8.2%. Disney's in on the party as well, up 7%. The darling of the ball is no doubt AMD, up 17%. Maybe the losers would be consumer staples and defensive utilities, but I'm liking what I'm seeing, and I'm feeling, I'm vibing, I'm shucking, I'm jiving. It's an up market. You can't help but feel a little bit richer today. As rude as that may sound, the S&P 500's up 1.2%, intraday highs, all-time highs. The Dow's up 1.2%, 49,895, getting close to its all-time high. The NASDAQ up 1.5%, all-time high, 25,705. Russell 2000 up 1%, all-time high as well. Bitcoin's up 2.7%, up $2,150 to 80,937. Crude's down on news that we're getting closer to a deal. It's not there yet, though. Is that a killer? You're seeing broad strength today. NVIDIA, who may or may not be along for the party with AMD, but they're up $10 today to $206. I guess you could say with AMD recently reporting last night, we're pretty deep into earnings season for AI companies, and they're putting up, and they are not shutting up. Interesting again to note that some of my stocks like Apple and Visa, they tend not to do well when the AI trade does great. I'm not a trader, but that pattern is obvious to me. I do have Patrick O'Hare coming up later in the show to talk more about what he's seen in the markets. Essentially, we woke up this morning and stock futures had jumped, oil had plunged. Axios had reported the Iran war may be nearing an end soon. Washington and Tehran are the closest they've come to an agreement since attacks began on February 28th. If the war comes to an end today, tomorrow, this weekend, travel and leisure stocks will do well, as will any aerospace companies. Boeing in particular. Delta's up 6%, GE Aerospace and Boeing up 4% as we get closer to the war ending. And there's also another theory being floated around that as President Trump is set to meet with China's Xi Jinping later this month, there could be a big aircraft order as well for Boeing, as well as if the war's not over, that's the time for China to say, look how great we are. We can end wars. Corning and NVIDIA, they announced a massive deal on optical technology. Corning will build 3 new plants, increasing its domestic optical manufacturing capacity by 10-fold. NVIDIA secures the supply it needs as optics replace more copper in data centers. That shift is the reason Corning looks attractive. Up 15% today. Optics have moved in. Lumentum's a name as well. The deal is structured around Corning issuing NVIDIA 2 types of warrants. Pre-funded warrants for 3 million Corning shares, which account for the bulk of the $500 million to the fiber optics company. And traditional warrants that enable NVIDIA to buy 15 million shares at $180 a share, thereby benefiting from Corning's share price trading above that level within 3 years' time, unless the partnership is terminated or Corning makes a fundamental transaction before then. Right now, Corning's at $184 a share. So in theory, NVIDIA's showing you how financially they can engineer and how strong they are as a corporation on their balance sheet. It's not as big of a deal as the $2 billion investment that they just recently put into Marvell. Ticker symbol MRVL, up 40 basis points. Coherent up 3.4% today, and Lumentum is down 6% today on a big day on Wall Street. Let's talk a little bit more about AI winner, AMD. I own it not directly, but through QQQs and S&P 500 funds, so I'm stoked. CEO Lisa Su predicted the server CPU market would be $120 billion by 2030. The CPU side of it. That's big. Why? You just can't make a prediction. You can't Nostradamus. Agents are really driving tremendous demand in overall AI adoption cycle, and we're very excited to be in the middle of it. Everywhere I go now on the internet has an agent that wants to help me. And they're better than they used to be, which is nice. Revenue climbed 38% year over year for AMD, highlighting the company's data center business as the primary driver. She sees a shifting of the workload. It's become clear over the last 90 days as the largest customers jump in and have their opinions. The CPUs, the world has changed. Amidst sentiment that the CPU growth trajectory has changed, so says Morgan Stanley analyst Joseph Moore. The CPUs have joined high bandwidth chips as the apple of AI investors' eyes. AI agents are being asked to do more and make more decisions. Not all of their processes require a Mensa level mind that is a GPU. In many of the cases, a CPU will do. The appropriate ratio of CPUs to GPUs in order to run AI models used to be 1 in 4, 1 in 8, but now it's closer to 1 in 1. Both management and analysts are taking a lot more CPUs into their considerations for expected growth opportunities for the industry at large. Intel and ARM holdings are obviously geared towards AI CPUs. They've all doubled year to date. Bernstein analyst Stacy Rasgon noted that AMD has doubled its expectation of the CPU market. A few months ago, it was just $60 million. Did I say million? Billion? $60 billion. Now it's $120 billion. One analyst upgraded their price target on AMD to outperform from market perform. $525 price target. So it was a standout report for AMD. Beyond the upside results and guidance, the key driver behind the move appears to be the longer-term commentary around the data center, particularly server CPUs. The updated CPU outlook suggests a much stronger demand environment than previously anticipated. Anthropic committed to spend $200 billion this morning on Alphabet's Google Cloud over the next 5 years. It's a mad dash to secure capacity. Uber reported earnings this morning, up 8%, 1 point up 10%. We're supposed to hit 69 cents a share. They hit 72, $13.2 billion in revenue. Bookings of $53.7 billion versus expectations of $52.8 billion. They're forecasting earnings for the next quarter above expectations. They've long been an asset-light company where the contract drivers who bring their own vehicles to Uber's ride-hailing platform. That changed, though, as they've entered the robotaxi era. They've committed more than $10 billion to buying up robotaxi fleets and investing in the companies that make them. Uber spent $336 million in 2025 on capital expenses, and now they've committed over $10 billion. You could say that they've hit the gas, if you will. Mobility gross bookings grew 25% to $26.4 billion. Delivery rose 28% to $26 billion. Total trips grew 20% year over year to 3.6 billion. Mobility take rates reached record margins in the first quarter. The overall revenue growth of 14.5% trailed 25% bookings growth. This is a stock that I own. It's been a bit of an underperformer recently, but it was really an outperformer early on. It's not my biggest position in any way, shape, or form. It's not even my most average size. It's a little undersized, but they had a high quality quarter. The stock's reaction is reflecting growing confidence in the platform's compounding flywheel. The partner-led autonomous vehicle model adds long-term optionality with balance sheet risk. Uber One's ascent to 50 million members, now accounting for over half their gross bookings, is a structural moat in the making. Insurance-driven fare reductions in LA and San Francisco are visibly accelerating trip growth. SpaceX is in the news today, and Tesla's Terafab could cost $119 billion, far more than expected. I've heard numbers pushing up to $1 trillion by the time it gets done. Ultimately, the goal of Terafab is to build enough in-house AI chip capacity to supply both companies, Tesla and SpaceX. Most of this is going to be on SpaceX's balance sheet for the near while. So SpaceX is going to take care of the initial phase of the scaled up Terafab, any kind of intercompany thing has to be approved by both SpaceX and Tesla's board of directors. It's got to go through a conflict resolution. It's going to have, unfortunately, a lot of complexity because you got to make sure Tesla shareholders are served and SpaceX shareholders are served. It's a little complicated, a little muddy, but what does that man do that's not? Novo Nordisk shares jumped 7% this morning. Great numbers for its new Wegovy pill for obesity. Prescriptions totaled 1.3 million in the first quarter. Novo also raised its full-year guidance. Rockwell Automation had a nice quarter. A lot of people think they're going to be big, like Caterpillar's big into AI data centers. As an old stodgy company, a lot of people think Rockwell Automation is going to be big into not only data centers and semiconductors for automotive, but also for robots. Citibank hiked its price target on Cummins, which is a poor man's Caterpillar. $770 price target. Strong first quarter report. I don't dislike Cummins. Party like it's 1999. This is a note that comes from BTIG, Jonathan Skrinsky. He says, we have written ad nauseum about how extreme the move in semiconductors have been, in many cases not seen since the dot-com bubble. In some ways, this move is actually more extreme. If we look at the top 10 performing NASDAQ stocks in 1999, they were up an average of 559%. The top 10 in the year leading up to March 24th, 2000, were up an average of 622%. The top 10 NASDAQs over the last year are up 784%, currently beating the average of 1999 as well as the year prior to the March 2000 peak. So the issue is, in the dot-com bust, of course, was the fundamentals didn't support the price. The semiconductor index ultimately lost 84% from 2000 to 2002. Fundamentals are clearly better now, and we don't think we see anything like that kind of decline. But we could see a 25 to 30% correction that would only leave the semiconductor index at its 50-day moving average. Wow. That's how extended and crazy things have gotten in the last 3 months. If you exclude March, it's what a roll. Stocks often top on good news, and while we have clearly been too cautious on the group of late, all the makings of a swing high in semiconductors given the string of good earnings combined with the positive news out of the Middle East. The question is, if we do get a meaningful pullback in semiconductors, can other parts of the market pick it up and carry the slack? So Krinsky's been pretty bullish, but as of recently, he's seen that 50-day moving average just get throttled through by semiconductors. He gives more examples. In 1999, the best performing NASDAQ 100 stock was Qualcomm, up 2,600% in the 1 year prior to the dot-com peak. Now, again, the dot-com peak with 2000, you're not even getting Apple phones rocking and rolling. You're just doing that on .com and PCs hooking up to the internet. This year, the stock that everyone's amazed with is SanDisk, up 3,960%. Now, again, Qualcomm was up 2,600%. That's insane to look back on some of these numbers and how we've done well by sticking with, the top 25 names in the NASDAQ. Interestingly, the second best stock in 1999 was SanDisk, up 581%. Again, it's up 3,900% in the last year. Krinsky continued on. He's picking a fight with my NASDAQ boys. He says if we look at the top 10 performing NASDAQ stocks in 1999, they were up an average of 559%. The top 10 in the year leading up to 3/24/2000 were up an average of 622%. Now the top 10 names in the NASDAQ are up 784%. Don't look today, Jonathan. It's going to be a little bit worse. So I like that he's saying this. I like that he points out that in May, there was one sector ETF that hit an all-time high. It was the semiconductor tech industry. Real estate's doing well as well. Of the 11 sectors, 2 peaked in January, 4 in February, 2 in March. He thinks tech could be next. Now let's talk about an IPO that you should be taking an eyeball look at. It's called Cerebras Systems. Analyst Rohit Kulkarni added Cerebras Systems, a Sunnyvale-based AI chip designer that builds one of the world's largest semiconductors, the wafer scale engine, launched its IPO roadshow earlier this week. It could start trading publicly on May 14th. Ticker symbol is going to be CBRS. They're not looking to pull in crazy amounts of money, but about $35 billion. Something that could be easily acquired. People were impressed by the extraordinary revenue velocity, 20 times growth over the last 3 years to $510 million. They've got a transformative scale of the OpenAI compute agreement, $20 billion plus, take or pay across 3 tranches. Their architecture's structural fit for the inference era, 2,600 times memory bandwidth advantage off of high bandwidth memory chips. Now, that gets me thinking. In 2 weeks' time, we're going to be talking about this company that has a different bandwidth advantage over high bandwidth memory, which is what Micron and SanDisk do. The company's long-term margin targets 60% plus gross margins. Risks include extreme customer concentration, a widening non-GAAP operating loss. GAAP is generally accepted accounting principles. Near-term gross margin headwinds from cloud infrastructure investment and an ambitious valuation step up from $23 billion Series H just 3 months prior. Now it's going to be valued at about $35 billion. It'll probably come public higher. Ticker symbol, if you can get shares with whoever you broker with, is going to be CBRS. It's CBRS. I bring it up because it is going to be direct competition, in my opinion, to NVIDIA and to AMD. It's going to be a semiconductor play that we haven't seen, that's relatively new, that's got growing revenues. It'll be sexy and a lot of people will want to talk to them. I found something you might be interested in, Blackstone Digital Infrastructure Trust. Ticker symbol is going to be BXDC. It's going to set an IPO price. Wait till you hear what this company does. Blackstone is obviously a big asset manager in the world. Kind of like a Warren Buffett owning many types of companies and businesses. The trust's primary focus is on mission-critical data center assets that support cloud computing and AI infrastructure. Target acquisitions will be newly built, stabilized data centers valued between $250 million and $1.5 billion each. Initial investments will be concentrated in top-tier U.S. data center hubs like Northern Virginia, Ohio, Phoenix, Maryland, and Austin. They're looking for long-term leases. They're going to be a landlord to hyperscalers and others. They're going to raise rent 2% to 3% a year. They're going to try to yield to you and me 5.75% to 7%. It'll be extremely well vetted by Blackstone. It'll be externally managed by a Blackstone affiliate under a tiered fee arrangement. A tiered base fee starts at 1% per year on market capitalization of $25 billion. This may or may not be for you, but would you like to own real estate that manages the properties of data centers and targets 5.75% to 7% a year in income yields? Reach out and talk to me. I'll give you my opinion. Ticker symbol is going to be BXDC. It's BXDC. I'd love to hear from you. There's a lot of good news right now fueling optimism. It does feel spiky. You know that phrase on Wall Street, never sit on a spike? From our bottoms on the post of I will bomb Iran and end their civilization, from that point in time, it looks a little spiky. Is that going to stop me? No. If I get 2, 3, 4, 5 down days in the next couple, is that going to bother me? No. 3 years would bother me. 2 years would be difficult. 1 year after the last 3 years we've had, since we've had a bad year, and then before that, 3 great years, I'm not easily freak outable. Year to date, Brent crude, silver's up 4%, gold's up 6%, Bitcoin's down 8%. The Dow Jones Industrial Average is up just 2%. The S&P 500 up 5.8%, which is pretty good for 1/3 of the year. The Nasdaq's up 9%. Again, pretty great for 1/3 of the year. Russell 2000 up 13%. Wow. Magnificent 7 up 2.7%. All this feels about right. Coming up, I'm going to have Patrick O'Hare. Then I'm going to have a strategy segment right after that. See you in the afternoon, as well as see you at an upcoming event, a Pints and Portfolio. 10 days from now, need some people to sign up. so I don't have to PPD this one, but it's going to be in San Mateo 11-1. You can sign up at robblackshow.com. That's robblackshow.com. It's for anyone with 500,000 or 50 years old plus, heading towards retirement. I'll buy the beer. The whole idea is we'll talk financial planning in an informal setting with financial planners, one of them who I'm going to be working with in the next couple years. Julie, she's already met my family and nothing but good things to say. You can sign up for the event at robblackshow.com. That's robblackshow.com.
Join Rob Black and San Mateo Saturday, May 16th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11-1 for a little sunshine and a complimentary preliminary plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this financial snapshot can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, May 16th in San Mateo. Go to robblackshow.com and click the events tab. Find Pints and Portfolios and click to register. He'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this San Mateo event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com.
Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Joining me now, Patrick O'Hare from Briefing.com, a reliable source of domestic and international news you could use. He's a strategist, in my mind, is the best way of describing him. He looks big picture. He even writes a column called Big Picture on Fridays, but every morning talks about what's going to happen on the market. Sometimes it's about the economy. Sometimes it's about the stock market movers and shakers. Sometimes it's about bigger picture items, but it's always good content to see what's going to happen. Patrick, what's going to happen and why is the big question of the day.
Good morning, Rob. And I know what is happening today is that you have a market that's back in rally mode. And again, falling back on the hope or optimism that the Iran war might come to an end. But maybe even more to the point, it's continuing to focus on the tremendous growth prospects for AI and the build out that's needed for that. And you've seen some strong results out of advanced micro devices with some really upbeat commentary that's helped put a bid here. And so you have a risk-on market that's favoring a good growth outlook.
Again, I think I speak for many of us if we'd started the year and said there's going to be a 2 to 3 month war in Iran or strike in Iran, and the markets would be hitting all-time highs. Small caps would be leading us, even though the Federal Reserve may not raise interest rates this year. It's a weird puzzle that always falls into place, and somehow by the end of the year, it makes sense. What are your thoughts on the first third of the year?
Yeah, you captured it really well there, Rob. I frankly would have thought that small caps would be underperforming when you say interest rate cuts are being taken out of the equation, that you're seeing Treasury yields move up, and that you've seen a spike in oil above $100 per barrel. And we're just not seeing it, right? Everything's been flipped on its end because the market it continues to see through all of it. And what I titled the page one column this morning was that the market keeps climbing a wall of unworry. You hear daily all the reports of what the market should be concerned about, but you have a market that's at record highs despite all of these issues looming out there that have created a great deal of uncertainty. But the price action has been tremendous here, and it has continued to instill a willingness to buy on weakness. And when you pair that with the impressive earnings growth we've gotten out of the first quarter reporting season and some guidance that generally is fairly reassuring, particularly out of Disney and Uber today as it relates to the consumer, and you have a market that's just not fearful about earnings not living up to expectations, and therefore it's willing to pay up for earnings. And until you get some stronger signals out of corporate America that this game is up, you continue to see bullish bias driving things.
With that said, I have heard more commentary recently from financial media, CNBC and Bloomberg, of comparisons to the dot-com era. And the dot-com era, obviously the late 90s, internet stocks went through the roof, and then they ran into the wall of 2000 in March and took 2 or 3 years to hit a bottom. It wasn't a 2 to 3 week bottom. It was a long drop. Any thoughts on why this comparison's coming up now?
Certainly, you see you have I guess you call it a secular theme in place, that being the build out of AI. and you have a lot of stocks related to that theme that go up on either no news or incremental news and valuation increases that are just out of whack necessarily with the incremental news. And you have these parabolic stock charts, right? And I can relate to what you're talking about. I cut my teeth in this career during the dot-com bubble days. I started with briefing.com in 1997. And so I'm much older now. I like to think wiser. But there is admittedly an element of post-traumatic stress now that I am older in terms of chasing things here, knowing that if there is a correction that's driven by a fundamental catalyst, you could be trapped for a while trying to reclaim what you lost. And I think that you just have a bifurcated market in some respects there given by demographics. I think it's a market that a younger cohort will continue to be energized by and is excited by, just as I was during the dot-com days. But maybe the older cohort, so to speak, is understandably more cautious because they might be nearing the end of their careers, getting closer to retirement, and can't necessarily afford to ride out a large drawdown that's driven by either a recession or some type of fundamental catalyst that upends the earnings growth story. No one knows when that could come to fruition. It's bound to come to fruition. That's just the nature of things. But right now, you're in a market where it seems where there's an air of complacency about it, frankly, and you do have to wonder about some misallocation of capital when you see some of these stocks go up 15, 20, 30, 40% because they beat revenue by maybe 10%. It's something just to obviously be watchful of. But again, I guess given the years I have as a market analyst, you come back to the notion that the trend is your friend until it isn't. And you continue to abide by underlying fundamentals. And frankly, you have a market that looks stretched here in the near term, just clearly on a technical basis. But fundamentally, it's not that overstretched when you look at the growth rates that we're seeing here for the earnings picture. And so we can get a setback here, certainly, but I think that inclination to buy into the weakness will remain.
The way it's summed up, and I've drank the Kool-Aid, so please know that. I live in the Bay Area, is that AI leads to profit margin expansion. Profit margin leads to earnings expansion. Earnings expansion is driving the market in the long term. So I've fully drank the Kool-Aid, but I'm with you. When does oil at almost $100 hit inflation? When does super small beats and super stock rallies, when does it lead to overextension? It feels like it's been a long time. And I need you, Patrick, to keep me honest, if that's possible.
Well, I think, too, though, it's also probably the key thing is when does all this hit the labor market, right? Because consumers are gainfully employed, they're going to continue to spend.
That's right.
And so that's probably the real fly in the ointment here is if you get a crack in the labor market. And while hiring activity has been slow, you haven't seen a lot of layoff activity, frankly. And then even the ADP employment change report we got this morning was pretty decent. Saw growth across all regions, growth across all sizes of businesses, led by small and large cap businesses. And so again, it's just anecdotally and even objectively, you can see that that the labor market is still holding up reasonably well. Now, the kind of the elephant in the room is what does happen with AI, right? You might get this tremendous profit margin expansion at the corporate level, but does that come at the expense of the personal level, right? And I think that's what's, again, is something that worries a lot of people. I would hasten to add that when the dot-com days were doing what they were doing in terms of the positive end of things, there were fears about a lot of people losing their jobs then, too, and that there was some of that, but it didn't necessarily come to fruition in a big way. But maybe a little bit different dynamic here with AI because of the threat to knowledge workers. And so there's a lot to still unfold here, but I think that the fact that you've got a labor market that's hanging in there reasonably well helps underpin consumer spending activity and the economic growth that we're seeing.
Any final thoughts? We've got about 2 minutes left. We've
got the April employment report coming out on Friday, and it's always the most important economic piece of data to watch. It's comprehensive, and what we talked about a little bit last week even is what's going on with the average hourly earnings growth, right? It's like in terms of what's happening with real earnings here. We clearly still have an inflation issue, And if you get real earnings that aren't keeping, if you get earnings that aren't keeping pace with inflation, you're going to have consumers that are going to get more stretched. They're going to have to spend on credit, or they have to dip into their savings. And then that can become a headwind, certainly, for the strong consumer spending activity we've seen to date. So keeping a close watch on that as when that report comes out.
Thanks very much. It's Patrick O'Hare, a reliable source of domestic and international news you could use. I start my day every day with his page one. I end my week with his big picture. Solid information like he just threw down there. And it's a head scratcher at times, but you just sit back and watch what the market does, and you put it into perspective and digest and learn and move on with a lot of experience. You're listening to Rob Black and Your Money. I'm Rob Black, talking all things financial. That was Patrick O'Hare with Briefing.com.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
Thanks for listening. It's not lost on me that you're putting yourself in the position of not listening to sports talk or Dr. Laura insulting you in your life choices, of which we all have plenty of bad ones. I appreciate you listening. I do 2 podcasts a day, one in the morning and one in the afternoon. Probably this time next year, I'll be off of radio and just doing one podcast. So help me form the content. I want to deliver to you what is most important to you. Drop me an email, rob@robblack.com. It's rob@robblack.com. We'll see. Maybe I'll stick around in radio. I don't know. I've been doing it such a long time. I'm just trying to tinker with the right content. You can sign up for any event that I do at robblackshow.com. Citadel. Their CEO, Ken Griffin, was on CNBC today. And he's one of those billionaires, when he talks, I do pay attention. He says, we're very focused on how long the Iran war will last. Reopening the Strait of Hormuz will take some time, which will push oil prices higher. Higher oil prices will likely push the world into a global recession, but the U.S. will be largely shielded from that because of our energy independence. He mentioned that the labor market is strong, yet to see the impact of AI on the bottom line. He has yet to see the impact of AI on the bottom line. He said today, AI is much different. It's much better than it was 9 months ago. He thinks that the ability for the Fed to cut rates is diminished, but the market is focused on the earnings success story. He thinks President Trump has done a great service to humanity by curtailing Iran. He thinks a nuclear-free Middle East is very important for national security. So Citadel's CEO, Ken Griffin, he hits a lot of content. He thinks Europe needs to carry the water more on geopolitical issues. He believes that Democrats will take the House of Representatives in 2026, but Republicans will keep control of the Senate. He was really upset at New York City Mayor Zoran Mondani. He says, Mondani put me in harm's way, and it was very inappropriate. He will probably move forward with a new New York City building, but he also said, we'll add far more jobs in Miami as a direct result of the policies of New York City. New York City has to control spending and the size of its government. Wow. He says it all. And I'm telling you, like, did you see the Met and how people protested Amazon's Jeff Bezos? There's a group that hates on Elon. They're activists, and they put 300 bottles of fake urine under tables to say, hey, look, Amazon CEO Jeff Bezos, or ex-CEO, is right there. He's at the Met. His company forces employees to pee in their vehicles in pee jugs. Why? No, wait. You're going to love this. I actually know of one other person in the world who's ever used the word pee jugs. And it was a woman I was dating named Christy, 20 plus years ago. She was from Calgary. Her boyfriend in the winter said it would get so cold that he would sit up in his bed, grab his pee jug and pee on the side of the bed and put the jug by the side of the bed. I'm like, oh my God, I've never heard anything such like that. That's the greatest story I've ever heard, or the worst, because it was so cold in Calgary, he didn't want to walk to the restroom.
Take off, you hosers.
So investing in your 30s, 40s, 50s, and 60s is wildly different. Risk is a natural part of investing. Indeed, it's the volatility is the price of admission to long-term wealth. Risk does not exist in the market, and it does exist in the market. If you look like 3 years back, 5 years back, the lines on the market are kind of nice and smooth. If you look on a month-to-month, day-to-day, week-to-week, the lines are kind of crazy. So which one is it? Is the market risk-free? Or is there risk in it? I think short-term there's a risk. That's why when you're 60 years old, I think you should have a financial plan done for you probably by the time you're 55. I got mine done in the early 50s. Long-term trend is up and to the right. The stock market has rebounded sharply from each recent sell-off and every sell-off in history. The stock market has gone through $150 oil, $0 oil. It's gone through 9/11. It's gone through the Iraq War I, Iraq War II. It's gone through the Iran War, Strait of Hormuz War. The stock market has gone through World War I, World War II, Vietnam, Korea. It's done okay. It'll continue to do okay as long as we have quasi-capitalism and less so socialism. I don't look at the stock market as anything other than capitalism. Time is on your side in your 30s and 40s. Warren Buffett was once on the Dan Patrick Show, and he famously quipped, "It's pretty easy to get well-to-do slowly, but it's not easy to get rich quick." So if you're in your 20s, 30s, and 40s, take your time. Get things like acorns and max out your 401k, and when you get a bonus, put it in a savings account. Don't put it into a new car or new fancy shoes. I want my boogie shoes. No, I really don't. I'm fine with my sneaks.
I think you just killed my favorite song of all time.
My mom clearly didn't pay me for singing lessons. For folks in their 50s and 60s, as you start to near retirement, managing risk looks a little different than your 20s, 30s, and 40s. If I can go back to my 20s, I would do S&P 500 funds, Wilshire 5000, some small cap, some mid cap, some international. Cheapest ETFs I could find, or ETFs that most align with my thoughts. It would probably be 5 total picks. And then in my 20s, I would have made love, sweet love. I would have been happy. I would have traveled the world. I'd have 80% less than I do now. But that's okay. I would have been happier. If you're in your 50s and 60s and you're near retirement, you really need a financial plan. It makes sense to have more balance in your portfolio, more income in your portfolio, less volatility in your portfolio. Keep in mind, I'm in my 50s and I just bought a stock that was already up 400+%. I was like, I'm buying it on a dip. It was a good dip. So I'm not so sure about saying, oh, you should definitely get in fixed income or you should definitely get into bonds. I can tell you, you do not want to be in annuities. I would be very careful on longer dated bonds and treasuries. It ultimately boils down to, for investors at any stage in your journey, there's market risk. It's going to be unavoidable. When you're older, you have less time to recover. When you're younger, you should be out there making love and having happy moments and seeing sports and, cheering on the home team. You should be advancing your career. You should be learning how to invest better, how to save better. I still save money. Any coupon I can, I use, as long as it's something I was going to use anyway. You can always find me online at Rob Black Show. Come out and meet me at a Pints and Portfolio, May 16th. You can find me online and the event online at robblackshow.com. That's robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not on offer to sell or a solicitation to buy any security. Member FINRA SIPC.